Hello and good morning, everybody. It's a new week, and today we are going to look at the trend trading mistakes that kills consistency. And what I want you to understand is that trend trading sounds very simple, but sometimes people end up making losing money. So I will phrase it this way: that trend trading sounds simple. So basically, because we understand it's all about follow the trend, ride the move, and make the money. But if it was that simple, then most traders wouldn't keep getting stopped out in strong trends. So what you need to understand is that trends don't kill account. A trend doesn't kill accounts. Misunderstanding the trend is what destroys accounts. Okay, so most traders, they either enter too early or exit too early or confuse pullbacks with reversals. And in this video, I'll break down the trend trading mistakes that quietly destroy consistency even when you are technically right. There will be 5 mistakes that I'm going to share with you. So make sure you have somewhere to write down, because these mistakes, they are very simple. They can be easily be overlooked, but the moment you understand them, then trend trading will become easier for you. You'll start minimizing your losses and maximizing your wins. Okay, so this video is for traders who believe they trade with the trend but still struggle, get trapped buying tops in bullish markets, exit early out of fear, or feel confused when trends suddenly reverses. Okay, so if the trend trading feels inconsistency for you, then this video will fix the framework, right? So let me share my screen so that you can see. This is a very nice trend we are seeing at that particular point. We are going to discuss it. I'm just sharing my screen so that you can see what as I discuss some of these mistakes, you'll be able to understand them. But before even we dive into the mistakes, here is the shift that I want you to have: that a trend is not just a direction. What you are seeing here, this is not just a direction. Okay, so it's a structure plus liquidity plus timing. Remember, I've been emphasizing on these 3 things: structure, liquidity, plus timing. If I were you by now, if you have been watching those videos, that the ones that I've been sharing of late, if I were you, then I would want to understand the structure more. I would want to understand liquidity more. I would want to understand the aspect of timing more, because those 3 things will give you an edge in your trading. So if you only look at direction when trading, then you'll always be late. You will always be late. Okay, so mistake number 1. All right, mistake number 1 in trend trading, which makes you not to be consistency. Mistake number 1 is confusing momentum with the trend, right? Confusing momentum with the trend. Confusing momentum with trend. You realize that many traders see strong bullish candles and assume uptrend, right? And if it's uptrend, therefore they assume buys, right? So like in this case scenario, let me show you an example. This is a strong bullish candle. Yes, we're in an uptrend, but you see this strong bullish candle, but the market sells. All right, here the market sells. So if you're buying here, then you'll be in drawdowns in this perspective, in this case perspective. This is a strong bullish candle, a strong bullish candle here, right? But if you'll be buying this momentum, then the market retraces to around somewhere these levels, and that means you are in a drawdown. Okay, that means you are in a drawdown. Okay, so what we are saying is that don't confuse momentum with trend. Okay, but what you need to understand is that momentum isn't trend. For you to identify a trend requires series of higher highs for an uptrend and higher highs and higher lows for an uptrend, or maybe probably lower lows and lower lows for an uptrend. Okay, so that's what a bullish and bearish trend requires. So there is it requires also, a trend also requires structural continuation, right? So we are seeing that continuation of series of higher highs and higher lows, or lower lows and lower highs. So there is that aspect of liquidity sweep before expansion as well. We have to see liquidity is being swept before expansion, because if you look at some of these instances around this particular point, what we are seeing, when the price retraces here, we see liquidity sweep, and then now the price expands. Okay, we see liquidity sweeps, liquidity being swept, and then we see the price expand. Okay, so those are main things that you want to look at a trend. So a trend requires higher highs and higher lows for an uptrend, lower lows and lower highs for a for a bearish trend. Also, there is the structural continuation, and there is the aspect of liquidity sweep before expansion. So momentum can exist inside a pullback, because when you look at this kind of a scenario here, this is an uptrend, but there is a momentum also here in this pullback. There is momentum also here in this pullback. There is momentum also here in this pullback. So buying momentum at the end of expansion often means buying the tops, right? So if you buy this momentum at the end of the expansion, then it means you're buying at the top, and of course you'll be caught with the pullbacks, right? So trend is about sequence, not speed. Okay, trend is about sequence and not speed. Mistake number two in trend trading that kills consistency is entering too late, right? Entering too late. So the most common trend mistake, entering after expansion. Okay, you enter after expansion, price pushes aggressively, you feel FOMO, that is fear of missing out. You enter near the extreme, like in this level, price expands. So because of this expansion, you start entering because of FOMO. And what happens is that now the price retraces on the downside. Okay, the price retraces on the downside, right? So but you need to understand trends do breathe. So they expand, they pull back, and then they continue. Okay. So this is what I'm trying to say. They expand, they pull back, and then they continue. So there has to breathe. And the reason why we are seeing lower lows and lower highs, or higher highs and higher lows, because of this kind of situation. These are bullish. So a bearish, want to see expansion, pullback, and continuation. So these things are very mandatory when you're looking at it in terms of trading. So high probability trends entries often occur during pullbacks. So you have to wait for the price to pull back, right? You have to wait for the price. After this expansion, wait for the price to pull back, right? Wait for the price to pull back, and also align to your key points of interest, right? Align to your key points of interest. So you wait for the price. After this expansion, wait for the price to pull back, and you align yourself with the key points of interest. Like in this case scenario here, I can align myself with that because that's an order block, right? So I've always shared videos in terms of how to identify high probability order blocks. So you can go in my YouTube channel and try check that out, right? So high probability trade entries often occur during pullbacks. You have to note that, not breakouts, but pullbacks, because also people confuse breakouts for pullbacks. All right, breakouts, the people, traders do make losses even in pullbacks, because in breakouts, because they don't know how to understand that. But last Friday, I did a video about a breakout, why breakout traders get trapped, basically trying to explain the concept of liquidity. So you can go watch that video if you have not watched it. It will give you more insights. All right. So if you always if you're always entering trades on the breakout candle, then you're likely to be providing liquidity. Okay, so you're likely to be providing liquidity. You're likely to be providing liquidity. So always wait for the pullback, so that now you can be able to have a high probability trade. Number three, mistake number three, why trend trading traders make kill the consistency, or the mistakes. The mistake number three, for trend trading that kills consistency is fear of pullbacks. Fear of pullbacks. So you understand that in an uptrend, pullbacks are healthy, but beginners starts to panic. Price retraces slightly, they think it's reversing. They exit early. Then the trend resumes without them. Consistency dies when fear overrides a structure. So if higher lows remain intact, the trend is intact. Pullbacks are not failures, but they are opportunities if aligned correctly. So, like in this case scenario, what we understand is that you realize that in this case scenario, of course, uh, those who don't know how, especially the beginners, if you don't know how to identify a reversal, if you don't know how to identify when the market pulls back, right? If you don't know how to identify when the market pulls back, so or when the market reverses, I mean, so therefore you are likely to confuse these pullbacks as reversals, and now instead of waiting for the pullback to buy, you start now entering sales opportunities. The moment you enter sales, then the price continues to align itself. So as long as these laws have not been violated, because here they have not been violated, because this is just a week, a forced breakout here. So as long as these levels have not been violated, or the laws have not been violated, then we are still looking at a very intact bullish trajectory. Okay, as long as these laws have not been violated, we are still looking at a very intact bullish trajectory. So there is that fear of pullbacks. So traders, especially the newbies, they confuse the pullbacks with reversals, right? So you need to be able to understand how do we identify a reversal. And I'll give a very simple example, because again, I have a couple of videos trying to show you how to identify reversals. So if we are in an uptrend, right? If we're in an uptrend, and then now the market pushes down like this, so you can see here it was respecting these lows, all right? It is respecting these lows. During pullback, it is respecting these lows, but at this time, this low is being taken out. The body of the candlestick has to close below this point. So this is the point that now we say we have a change of character, and that does not mean that we now start entering sell. We have to wait for pullback, and then now we start entering a sell opportunity. So that's how reversals happen. So you have to be able to understand, to differentiate between reversals and pullbacks. What do you see in the market, so that you can know that this is just a pullback, or this is a reversal that has been confirmed. Okay, so that is very, very important. Pullbacks are not failures, they are opportunities if aligned correctly. Mistake number 4 in trend trading that kills consistency is ignoring liquidity in trends. Ignoring liquidity in trends. So even in strong trends, price will always seek liquidity. I'm repeating that 3 times. Price. It will always seek liquidity. So in an uptrend, price may sweep previous lows, break minor structures, and fake deeper retracements, right? Like in this case, what are we seeing here? So this is a trend all the way from here to here, but even as it pushes down this pullback, you see it is breaking minor structures, right? It is breaking minor structures. And the reason why, when you're marking the structure, it is always the way I recommend you look at the higher time frames, the monthly, weekly, and daily, so that it can give you the directional bias of the structure. And then now you have to understand that a structure in the higher time frame can have so many structures in the lower time frames. So the reason why you want to mark the major structures, you want to mark the major highs and the major lows. Okay, you want to mark the major highs and the major lows, so that now you don't get confused in the markets. And you need to understand that the price will always sweep this liquidity. As you can see, this is an uptrend, the price is sweeping the liquidities there. This is an uptrend. During this pullback, the price is sweeping liquidities. So you'll always find these instances here. Another scenario that the price is sweeping liquidity. Here too, the price is sweeping liquidity. And remember, we said when the price is sweeping liquidity, these liquidities are like fuel in the market. They create that. They're the ones that create. They keep the market going. Okay, so before continuation, so you have to understand that before continuation of a trend, if you don't expect liquidity grabs, you'll think the trend is broken. So you have to understand these liquidity grabs so that you don't confuse them with the trend, thinking that the trend has been violated. So this liquidity grab, right? So that you don't think that the market now has reversed and you start looking at sells, yet we are still in a very intact bullish trajectory. Okay, so trends often continue after clearing a weak hand, so it has to take out those liquidity, and therefore understanding this concept keeps you positioned correctly in the markets. All right, it keeps you positioned correctly in the market. And mistake number 5 in trend trading that kills consistency is over trading trends. Just because a market is trending doesn't mean every candle is tradable. High probability trend trades require clear pullback, liquidity alignment, session timing, and structural confirmation. Right? I repeat that. High probability trend trading requires clear pullbacks. So you want to see clear pullbacks. You want to see liquidity alignment, the price taking out those liquidities. Session timing as well. The moment that you're entering the trade should be the best time. I've always talked about the kill zones because I trade ICT. And also there has to be structural confirmation that the price has not broken the structure. We are still the price has not reversed. We are still looking maybe probably at an uptrend. Okay, so why is this important? Because taking every minor retracement destroys consistency, and therefore it is only through being selective that protects profits. So selectivity is what is going to make you protect your profits. All right, so that is very, very significant, and I believe you have taken points. You can always pause, reverse, listen to what I've said, make notes, try to understand even from the screens that I'm sharing, so that you can be able to see exactly what I'm talking about. Why am I saying this? Because initially I used to think that trading with the trend meant buying every bullish trend or every bearish move. Why? Because yes, it's true, the trend is your friend. But now, if you are not able to be selective, if you're not able to refine that and align yourself in terms of structure, liquidity, and time, therefore you might not be able to trade the trends successively. Okay, so and the moment I learned this, how to wait for the pullbacks with the liquidity alignment, then my trade count dropped. Right, my trade count dropped. That means I stopped trading every move and I became selective. Okay, and consistency therefore improved. Why? Because clarity replaced urgency. Right, clarity replaced urgency. So this is what I'm saying in a nutshell when you talk about trend trading mistakes that kills consistency. So trend trading fails when you chase momentum, you fear pullbacks, you ignore liquidity, you enter late, and you overtrade. A real trend has structural confirmation, pullback entry, liquidity alignment, and patience, right? So why? Because trend rewards discipline, not excitement, right? So in the next video, I'll be talking about how to read candlesticks without memorizing the patterns, because you don't need to memorize 20 candle formation to understand what price is saying, right? So until then, see you in the next one.